Have you ever wondered, a gentle, persistent wondering, why certain people seem to grow wealthier simply by spending their money, while others work endlessly, gathering nothing but exhaustion and the faint memory of what they once purchased? Tonight, we embark on a journey into the hidden architecture of modern wealth, the mathematical secret that rests beneath the surface of every transaction you make, every swipe, every digital payment, every dollar that leaves your account and never truly returns, because there exists a profound asymmetry in our financial world, a curious inversion where consumption itself becomes a form of production, where spending money actually generates more money, but only if you already possess a sufficient fortune to begin with. Have you ever considered that there might be a mathematics underlying human wealth itself, a cold, indifferent calculus that determines who rises and who remains still? As we settle into this evening together, as your mind begins its gentle descent into that curious space between wakefulness and sleep, I invite you to explore with me the equations nobody teaches in ordinary schools, the formulas that bankers whisper in mahogany offices, the patterns that have shaped our world more profoundly than any revolution or war or political movement ever could, because wealth, true wealth, is not merely about having money, it is about understanding the invisible machinery that transforms the simple act of spending into the grand accumulation of future abundance. So, if you find these whispered truths bringing a gentle peace to your evening, you might consider, in your own quiet way, subscribing to our channel, so we might continue exploring these forgotten corridors of economic history together in the nights ahead. But for now, let us drift backward through time itself, before there were credit cards, before there were banking systems, before there were even proper currencies. The wealthy possessed something far more valuable, something far more essential: time. The wealthy always had time. While farmers labored in the fields under the weight of the sun, the wealthy could sit in cool courtyards, counting their advantages. In ancient Rome, in ancient Egypt, in ancient Mesopotamia, the mathematics of privilege began with a simple principle: if you possessed surplus, you could distribute it in ways that benefited you. A landowner could give grain to a peasant in exchange for future service. A merchant could lend coins to a traveler in exchange for a portion of the traveler's future profits. This was not charity. This was mathematics, the mathematics of compounding obligation, of transforming present resources into future control. As centuries turned, as empires rose and fell like breathing, the principle remained eternal, unchanged, fundamental. The rich man's spending was never truly spending. It was always investment. The rich man's consumption was always a form of production for others to labor toward. And in medieval Europe, in the merchant republics of Venice and Florence, this ancient principle took on new forms. The banking families, the Medici, the Bodri, the Peruzzi, they began to understand something profound, a mathematical reality that would reshape human civilization. If you possessed money, and you loaned that money, you could claim a percentage of future production. Forever, you could capture a permanent slice of human effort, and this percentage, this fraction, this mathematical ratio, could multiply through time, as the borrower repaid not just the principal, but the interest on the interest, the compounding layers of obligation, stacked like stones in an endless tower, growing upward toward infinity, toward a mathematical horizon that could never be reached, but always drew people forward, deeper into debt, deeper into service. And so you see, even in these ancient times, Spending was different for those who had abundance, because their spending created the conditions for future receiving. In the 17th century, in the coffee houses of Amsterdam, a curious thing emerged from the minds of clever merchants: paper, simple paper, with writing upon it, a promise, a contract, a guarantee that you could exchange this paper for actual value, for actual goods, for actual gold. And what emerged from this simple innovation was almost miraculous in its implications. You could carry wealth without carrying weight. You could transport value across continents without the physical burden of heavy coins, without the danger of robbery, of loss, of damage. And with this paper, this promise, this beautiful fiction of human trust, the wealthy discovered something extraordinary. They could spend without depleting. They could consume without reducing their total holdings, because the paper promised that more value would come from future endeavors, from future ventures, from the future productivity of the world that they alone could access. Think on this for a moment. Imagine you are a wealthy merchant in Amsterdam in the year 1680. You possess in your vaults 2,000 gold coins, a fortune beyond measure, but you need not spend these coins to live magnificently. You need not diminish your actual holdings. Instead, you visit the banker and you exchange 100 coins for paper promises worth 500. You distribute this paper to your suppliers, your servants, your business partners, and they accept it gladly because they trust your name, your reputation, your demonstrated ability to honor such promises. And so, you have spent, in effect, 500 units of value, while only reducing your physical holdings by 100. The difference, the gap, between what you spent and what you truly gave, is pure mathematics. It is pure belief. It is pure confidence in your future ability to generate wealth. And immediately, something remarkable occurs. Your suppliers are grateful. They spread word of your magnificent spending, your generosity, your trust in their work, and thus, your reputation grows, your trustworthiness increases, and the next time you visit the banker, he will exchange 100 coins, not for 500, but for 700, or perhaps 1,000. The mathematics compounds, the advantage deepens, and now you see so clearly why spending money for the wealthy is never merely spending. It is always an investment in the mechanism itself that generates future advantage. As we move through the centuries, as we approach our own modern era, the mathematical apparatus grows more complex, more sophisticated, more invisible. By the 19th century, the foundations of modern banking had been firmly established, and a crucial discovery had transformed the world: the discovery of credit, not as a simple loan from one person to another, but as an abstract mathematical phenomenon, a tool that could be manufactured, distributed, and infinitely multiplied. Imagine this scenario: a bank holds $100,000 in its vaults, physical money, real value, concrete and measurable. But the bank understands mathematics, and so the bank creates credit, intangible credit, based on the reasonable expectation that its deposits will grow, that its borrowers will repay, that the system itself will expand. And the bank loans out, not $100,000, but $200,000, or $300,000, or $500,000. The bank has created, from mathematical principle alone, value that did not physically exist, and this value flows into the economy. It allows merchants to expand. It allows manufacturers to build. It allows entrepreneurs to dream. And the bank takes a percentage for this magical creation. this alchemy, this mathematical transformation of promise into tangible money. And the people who understand this first, the people who see the pattern, the people who comprehend the elegant simplicity of this mathematical trick, become extraordinarily wealthy. In Victorian England, in the Gilded Age of America, these people accumulated fortunes that seemed almost impossible, not through labor, not through innovation, but through understanding, through comprehending the hidden architecture of finance, and understanding that credit is the greatest invention in human history, because credit allows you to spend without having earned, to consume before you have produced. And if you understand this principle, if you can navigate it skillfully, if you possess already enough wealth to be credible, to be trustworthy, to have sufficient collateral, then you can spend, and spending becomes not depletion, but multiplication. You spend money that does not quite exist on investments that multiply, and the multiplication belongs to you, not to the creditor, because you possess the knowledge, the connections, the education that the system rewards with exponential returns. And then, in 1950, in the post-war American landscape, a revolution occurred, so subtle, so perfectly engineered, that most people never recognized it as a revolution. The credit card emerged, a rectangular piece of plastic, a bit of metal embedded within, a simple tool that would reshape human behavior and human consciousness for generations to come. The credit card was marketed to the public as a convenience, a way to carry purchasing power without the burden of physical cash. And this was true. It was convenient, but it was also something far more profound. It was a technological manifestation of an economic principle that had existed for centuries, but never before had been distributed so democratically, so widely, so universally. The credit card allowed ordinary people, for the first time, to spend money that they did not possess, to engage in consumption before they had earned the wages to pay for it. It was a beautiful democratization of a privilege that had once belonged only to the wealthy. But here is where the mathematics becomes crucial. Here is where the hidden architecture reveals itself. Because the credit card, unlike the ancient paper promises, unlike the medieval letters of credit, charges interest, and it charges interest, not on the full amount, but on the unpaid balance, and it compounds, and compounds, and compounds. The mathematics is exact. The mathematics is cold. The mathematics never varies. Let us consider a simple scenario. An ordinary American, with an annual income of $50,000, uses a credit card to purchase $1,000 that they cannot afford, perhaps for clothing, perhaps for a vacation, perhaps for medical expenses. The credit card company charges 20% annual interest, common rate. The cardholder pays the minimum payment, $100 per month, a reasonable sum. It seems manageable, it seems possible, but the mathematics says otherwise. The mathematics says that at this rate, at these compound percentages, the cardholder will take nearly 13 months to pay off the original purchase, and will pay nearly $250 in pure interest. The original $1,000 has become $1,250, and this difference, this pure mathematic, never created value, never created goods, never created anything tangible. It is simply money flowing from the person who has less to the institution that understands compounding. But here is where it becomes extraordinary. Here is where the mathematics reveals the hidden advantage that the wealthy possess, because the wealthy person receives a different card, a premium card, a black card, or a platinum card, and this card comes with a crucial feature, a feature almost never mentioned, a grace period. And with this grace period, often stretching 40, 50, 60 days, the wealthy person can purchase without interest, can delay payment without penalty, can float their purchases on the credit card company's money for weeks and weeks and weeks. And if the wealthy person is clever, which wealthy people typically are, they deposit the money that would have gone to pay the card into a high-yield investment account, earning 6%, 7%, 8% annually. And the mathematics inverts. The wealthy person is not paying interest. They are earning interest on money that belongs to someone else, on money that they are spending, that they do not yet own. In the 1980s, as competition among credit card companies intensified, as the market became saturated with plastic promises, a marketing executive somewhere in an American corporation had a thought, a simple thought, that would fundamentally alter the mathematics of consumer spending. What if, this executive wondered, we gave customers something back for their spending? What if every dollar that they charged returned them a fraction of a cent, or a fraction of a point toward something, toward free travel, toward free merchandise, toward some distant reward that would cost the credit card company very little to provide, but would feel, to the consumer, like a genuine benefit, like a genuine value, like a genuine return on their spending. And from this moment, the rewards program was born, and it is impossible to overstate the mathematical genius of this innovation, because the rewards program created a psychological inversion. It transformed the act of spending from a loss into a form of gain. A person with a traditional credit card spends $100 and experiences a sensation of loss, of depletion, of money leaving their account, of material resources diminishing. But a person with a rewards card spends $100 and sees, in bright red text on their receipt, you have earned 1 point, or 1% cash back, or 1 mile, and this person experiences a sensation of gain, of accumulation, of collecting something, of building toward a reward. The mathematics is identical. The actual value transfer is essentially the same, but the psychology, the perception, the felt experience is completely inverted, and this inversion is not accidental, it is engineered, it is deliberately designed to maximize spending among those with the means to support such programs. And here, in this inversion, we see the real secret, the real mathematics behind why rich people get paid to spend money, because the rewards program is not actually an expense to the credit card company. It is an investment in behavioral modification, in encouraging increased spending. And the credit card company knows with certainty that when you offer rewards, spending increases by an average of 20 to 40%, that a person with a cashback card will spend more than a person with a traditional card, and that marginal increase in spending is easily 3 times more valuable to the credit card company than the actual cashback they must provide. For example, if you spend $10,000 a year with a traditional card and earn nothing, the credit card company earns perhaps 5 to 7% on that transaction volume. If you spend $12,000 a year with a rewards card and earn $100 in cash back, the credit card company earns substantially more, because the transaction volume has increased, and the benefits they provide cost them far less than the actual value they capture. And thus, the wealthy person who spends liberally, who takes full advantage of the reward structure, who understands the mathematics, gets paid to spend money, gets rewarded for consuming, gets actual cash, for the privilege of sending their wealth through the financial system. As we descend deeper into the mathematical foundations of modern wealth, we must confront a principle so fundamental, so basic, to the operation of all banking systems, that it is almost never discussed, almost never explained to the general public. The principle is called fractional reserve banking, and it is the mechanism through which the wealth gap between rich and poor is perpetually widened, perpetually deepened, perpetually entrenched. Imagine, if you will, a bank, any bank, a repository of funds, of money, that customers have deposited for safekeeping. The bank knows that not all customers will withdraw their money on the same day. This is mathematically certain. On any given day, some money comes in, some money goes out, but the total rarely depletes completely, and so the bank undertakes a calculation. The bank determines that if customers have deposited $1 million, the bank can safely loan out perhaps $800,000 or $900,000, keeping 20 to 30% in reserve for the inevitable daily withdrawals, and the bank loans out this $900,000 to borrowers who pay interest, and the interest flows to the bank as profit, as revenue, as compensation for the risk, for the service. But here is where it becomes mathematically extraordinary. Here is where the system multiplies itself through pure mathematics, because the borrower takes this $900,000 and deposits it in the bank or a different bank, and now the bank holds $1,900,000 in deposits and can therefore loan out $1,700,000 to new borrowers, and those borrowers deposit this money, and the bank can loan out $15,300,000, and on and on. The system multiplies through mathematics alone, through the fractional reserve principle, and there is no actual increase in physical wealth, no new goods, no new services, no new production, but there is a massive increase in the amount of money in the system, in the amount of financial claims on future production, and these claims flow upward into the hands of those who understand, who participate, who know the system, the wealthy, the educated, those with existing wealth, to leverage. Because here is the secret, the crucial secret: this multiplication only works if you have money to deposit to begin with. If you have no money, the system does not multiply for you. It only multiplies for those who already possess a sufficient beginning amount. The mathematics compounds, the gap widens, the advantage deepens, and the wealthy get wealthier, not through labor, not through innovation, not through production, but through understanding and participation in the system itself. There exists a realm, a landscape of financial activity that remains almost entirely hidden from ordinary people, from wage earners, from those who trade their time for income. This realm is called the world of investment, of passive income, of wealth that generates itself without labor, without effort, without the expenditure of hours, of energy, of human work. And it is in this realm that the truly extraordinary mathematics of wealth accumulation reveals itself. Imagine that you possess $100,000 in available capital. This is a substantial sum, a meaningful amount, the kind of wealth that most people spend decades accumulating, if it is accumulated at all. But if you possess this amount, you can engage in a specific financial behavior. You can invest it in dividend-bearing stocks, or in bonds, or in real estate, or in numerous other vehicles, and you can generate an annual return of 5%, or 6%, or in some cases, 7% or higher. This means that your money, your capital, generates for you $5,000 or $6,000 per year. Without your effort, without your work, without any labor on your part, the money generates money. The capital generates returns, and these returns are taxed at a lower rate than ordinary income. This is not accidental. This is engineered. It is written into the tax code, deliberately designed to reward those who possess capital rather than those who expend labor. The wealthy person with $100,000 earning $6,000 per year in investment returns pays capital gains tax, perhaps 15%, leaving $4,800 to reinvest, to compound, to multiply. But the ordinary person, earning $50,000 through labor, through the expenditure of their time and energy, pays ordinary income tax, perhaps 25% or higher, leaving perhaps $37,500. But proportionally, the ordinary person keeps far less, retains far less than the wealthy person. The mathematics is written into the law itself, and when the wealthy person spends money from their investment returns, they are spending money that has been generated without cost, without labor, without depletion of their original capital. The original 100,000 remains intact, continuing to generate year after year after year, compound upon itself, and thus spending for the wealthy person is fundamentally different. It is not depletion, it is not loss, it is the mere consumption of generated abundance. The mathematics ensures that if you begin with sufficient capital, you will never deplete it, you will never exhaust it, you will only grow it deeper and deeper into the future. This is why rich people get paid to spend money, because their spending is not a drain on their wealth, it is merely the harvesting of the interest, the capture of the returns, the collection of the mathematics that has been working in their favor all along. If you sit in a quiet room and contemplate the taxation systems of modern nations, you will discover something profoundly curious, something that contradicts the stated principle that we are all equal before the law, that we all bear an equal burden in supporting society. You will discover that the wealthy pay less as a percentage of their income than the poor. This is not theory. This is measurable. This is documented. This is mathematical. A laborer earning $40,000 might pay $8,000 in income tax, that is 20% of their income. But a wealthy person earning $400,000 might pay $60,000 in income tax, that is 15% of their income. The wealthy person pays less, proportionally, even though they earn more. Absolutely. How is this possible? How can such an arrangement exist in a supposedly just system? The answer lies in the mathematics, the specifics, the details of how income is defined and categorized and taxed. You see, the law distinguishes between different types of income: wage income, business income, capital gains, dividends, and each type is taxed at different rates. These rates are not accidental. These distinctions are not neutral. They are constructed deliberately to advantage those who possess multiple sources of income, those who can employ sophisticated strategies, those who can hire tax accountants, tax attorneys, financial advisors, and thus, the wealthy person does not live primarily on wages. The wealthy person lives primarily on returns, on dividends, on capital gains, on appreciation, on income forms, that are taxed at lower rates, and therefore, despite earning far more, they pay less as a percentage, and thus, when the wealthy person spends money, they are often spending income that has been minimally taxed, spending money that retains maximum value. But more importantly still, the wealthy person can engage in a specific strategy called tax loss harvesting. Imagine you own stock that has appreciated from $10,000 to $15,000. You have a gain of $5,000, but you also own a different investment that has declined from $10,000 to $8,000. You have a loss of $2,000. The ordinary person might think the net is $3,000, but the wealthy person understands the mathematics. The wealthy person can sell both investments, claim the $3,000 gain, but then use the $2,000 loss to offset other income, and thus reduce their taxable income by $2,000. This is entirely legal. This is entirely sanctioned. This is purely mathematical. And if the wealthy person then immediately repurchases the first investment before 31 days have passed, they have maintained their position, but captured a tax benefit. The poor and middle class cannot do this. They do not have enough investments. They do not have enough capital. They do not have enough income sources. They cannot afford the accounting fees to execute such strategies, and thus, the mathematics widens the gap even further. When the wealthy person spends money, they are spending from an optimized, minimally taxed income stream. But when the ordinary person spends money, they are spending from income already reduced by tax burden. They are spending less. They are accumulating less. They are building less. For the future, there exists a form of wealth so common, so ordinary, that most people fail to perceive its mathematical properties, its extraordinary mathematics. This form of wealth is called real estate, property, land, buildings, structures that sit upon the earth and appreciate with time. The wealthy person understands that real estate operates according to different mathematical rules than liquid assets, than stocks, than bonds. When you purchase real estate, you purchase not just a structure, you purchase the potential for appreciation. The land beneath the building increases in value year after year as populations expand, as neighborhoods develop, as proximity to resources increases. And here is the crucial mathematics. The wealthy person purchases real estate not primarily with their own money, but with borrowed money, with a mortgage, with leverage. Imagine the wealthy person purchases a house for $500,000. They put down $100,000, their own money, and borrow $400,000 from a bank. Now, the property appreciates at 3% per year, a modest rate. The house is now worth $515,000. The gain is $15,000, but the wealthy person only invested $100,000, so the return is 15% on their actual investment. The leverage has multiplied the return, and this is entirely legal, entirely sanctioned. The mathematics rewards those who borrow to purchase, those who use leverage, but the ordinary person with $100,000 might purchase a modest home outright with no leverage and gain 3%, $3,000. The wealthy person, using the same capital but applying leverage, gains 15% on that capital, $15,000, 5 times more. And furthermore, the wealthy person can deduct the mortgage interest from their taxes. they can deduct the property taxes, they can deduct the maintenance cost, and thus, they reduce their taxable income, they reduce the amount of money that is exposed to taxation, but the ordinary homeowner cannot deduct the mortgage interest, cannot reduce their taxable burden, because they purchase the home primarily with cash, primarily from wages, primarily from income that was already taxed, and the appreciation waits patiently. The property continues to increase, and when the wealthy person decides to sell, they capture the gain. They pay capital gains tax at a lower rate than ordinary income tax. They pocket the difference, and then they borrow again, they purchase again, they leverage again, and the mathematics compounds again and again. When the wealthy person spends money to live, they are living on borrowed capital, on mortgaged assets, on property that is simultaneously generating wealth, generating returns, while providing shelter, while providing living space. Every dollar that a wealthy person spends on a beautiful home can simultaneously be working, generating appreciation, building equity, creating future returns. The mathematics is elegant, is complete, is almost perfectly designed to ensure that wealth continues to flow in the direction where it already exists, and that those without substantial capital cannot access, cannot employ, cannot utilize to build their own futures. There is a story, often told in financial circles, a mathematical parable that illuminates the extraordinary power of compound interest, the power of mathematics to create wealth seemingly from nothing. The story goes that Albert Einstein once called compound interest the eighth wonder of the world. Whether he actually said this matters less than the mathematical truth embedded within the statement. Let us consider a mathematical scenario. Imagine two people, both age 25. Person A, wealthy person A, invests $5,000 in a diversified portfolio and earns, on average, 7% per year. Compound interest. They make this investment every single year for 10 years, 10 total investments of $5,000 each, a total contribution of $50,000. Person B, ordinary person B, cannot afford to invest anything until age 35, when they finally have $50,000 accumulated from wages, from savings. They then invest this entire sum and earn 7% annually, compound. But they begin 10 years later. What happens over the subsequent decades as both individuals let their money work without touching it, without withdrawing, without interruption? Person A's $50,000 investment, growing at 7%, compounded annually, will become, by age 65, by the time retirement occurs, approximately $570,000. 40 years of compounding. Person B's $50,000, growing at the same rate, but beginning 10 years later, will become approximately $290,000. 30 years of compounding. The difference is approximately $280,000. $280,000 generated purely by mathematics, purely by the power of starting earlier, of beginning sooner. And the wealthy person understand this. They understand that every dollar invested early works longer, multiplies deeper, compounds further, and returns more, exponentially more. The mathematics is absolute. It is not opinion. It is not debatable. It is pure calculation. And the wealthy person also understands something even more crucial. They understand that as they spend from current income, from interest, from dividend payments, the principal, the original investment, continues to work, continues to compound, continues to generate more and more wealth, year after year. And thus, when the wealthy person spends money, they are spending generated wealth, they are spending the fruit of the mathematical machinery that has been operating in their favor for decades. The original capital, untouched, the original investment, pristine, still working, still compounding, still generating more. This is the mathematics that creates dynastic wealth, that ensures that families, wealthy for one generation, become wealthier in the next. The mathematics is inexorable, is deterministic, is almost impossible to interrupt or to overcome. If you begin with wealth, the mathematics ensures that you will compound, that you will grow, that you will accumulate ever more. But if you begin without wealth, the mathematics works in the opposite direction. Every purchase depletes, every expense reduces, and you never reach the critical threshold of capital required to reverse the mathematics, to harness compound interest for yourself, and thus the wealthy person gets paid to spend because they have crossed that threshold. They possess the critical mass of capital required to make the mathematics work in their favor in every direction. Simultaneously, there is a story, often told in financial circles, a mathematical parable that illuminates the extraordinary power of compound interest, the power of mathematics to create wealth seemingly from nothing. The story goes that Albert Einstein once called compound interest the eighth wonder of the world. Whether he actually said this matters less than the mathematical truth embedded within the statement. Let us consider a mathematical scenario. Imagine two people, both age 25. Person A, wealthy person A, invests $5,000 in a diversified portfolio and earns, on average, 7% per year. Compound interest. They make this investment every single year for 10 years. 10 total investments of $5,000 each, a total contribution of $50,000. Person B, ordinary person B, cannot afford to invest anything until age 35, when they finally have $50,000 accumulated from wages, from savings. They then invest this entire sum and earn 7% annually, compound. But they begin 10 years later. What happens over the subsequent decades as both individuals let their money work without touching it, without withdrawing, without interruption? Person A's $50,000 investment, growing at 7%, compounded annually, will become, by age 65, by the time retirement occurs, approximately $570,000. 40 years of compounding. Person B's $50,000, growing at the same rate, but beginning 10 years later, will become approximately $290,000. 30 years of compounding. The difference is approximately $280,000. $280,000, generated purely by mathematics, purely by the power of starting earlier, of beginning sooner. And the wealthy person understand this. They understand that every dollar invested early works longer, multiplies deeper, compounds further, and returns more, exponentially more. The mathematics is absolute. It is not opinion. It is not debatable. It is pure calculation. And the wealthy person also understands something even more crucial. They understand that as they spend from current income, from interest, from dividend payments, the principal, the original investment, continues to work, continues to compound, continues to generate more and more wealth, year after year. And thus, when the wealthy person spends money, They are spending generated wealth. They are spending the fruit of the mathematical machinery that has been operating in their favor for decades. The original capital, untouched. The original investment, pristine, still working, still compounding, still generating more. This is the mathematics that creates dynastic wealth, that ensures that families, wealthy for one generation, become wealthier in the next. The mathematics is inexorable, is deterministic, is almost impossible to interrupt or to overcome. If you begin with wealth, the mathematics ensures that you will compound, that you will grow, that you will accumulate ever more. But if you begin without wealth, the mathematics works in the opposite direction. Every purchase depletes, every expense reduces, and you never reach the critical threshold of capital required to reverse the mathematics, to harness compound interest for yourself, and thus the wealthy person gets paid to spend because they have crossed that threshold. They possess the critical mass of capital required to make the mathematics work in their favor in every direction, simultaneously. In the modern world, in our contemporary moment, there exists a profound marketing apparatus, a machinery of persuasion, of aspiration, of desire creation, that operates almost entirely invisibly. Most people do not perceive this machinery. Most people feel the effects, but do not see the mechanism behind the curtain. And this machinery, this apparatus, is designed with extraordinary precision to achieve a single goal: to separate the poor and middle class from their money, to convince them to desire what they cannot sustain, to purchase what they cannot afford, to accumulate what they cannot maintain. The mechanism works like this. First, the wealthy are shown beautiful things, luxury goods, elegant services, limited editions, exclusivity, rarity. These offerings are priced impossibly high, beyond the reach of ordinary consumers. But the marketing, the advertisements, the media make these items highly visible, highly desirable, extraordinarily aspirational. Then, the manufacturers create lower versions, cheaper versions, accessible versions of these same luxury goods. A handbag that costs $3,000 might inspire the creation of a knockoff, a replica, an imitation that costs $100 or $200. The poor and middle class consumer sees the beautiful luxury item, sees the price, experiences desire, experiences longing, cannot afford the authentic version, but can afford the imitation, and so they purchase the imitation, believing that they have captured some essence, some quality, some aspirational value of the original, but they have not. What they have captured is marketing, is branding, is the psychology of association, and the wealthy person purchases the original and gains not just the object, but the authenticity, the genuine limited nature, the collectible value, the actual material superiority, and sometimes the appreciation of the item. Over time, the mathematics is cold, is clear. The wealthy person spends more, but accumulates goods that hold value, that appreciate, that become more valuable. Over time, the middle-class person spends less, but accumulates goods that depreciate, that lose value, that become worth less. Over time, the leather bag, purchased by the wealthy person for $3,000, becomes, with use, with age, more beautiful, more valuable, more desirable, and might be sold for $5,000. The imitation bag, purchased by the middle-class consumer for $150 becomes worn, faded, damaged, and might be discarded for nothing. The mathematics compounds, the gap widens, and the marketing machinery ensures that this dynamic continues, that aspiration continues, that desire continues, that the middle class continues to pursue, to purchase, to accumulate items that do not retain value, while the wealthy continue to accumulate items that do, and thus, when the wealthy person spends money, they are spending money that returns, that multiplies, that becomes more. But when the ordinary person spends money, they are spending money that disappears, that evaporates, that becomes less. If you find these patterns bringing clarity to your evening, if these mathematical truths are settling into your mind like snow, you might consider, in the gentleness of this late hour, sharing our channel with someone you care for, a quiet recommendation, a gentle suggestion, so that others might understand these patterns as you are understanding them now. There is a mathematical tragedy at the heart of our economic system, a mathematics so perfect, so complete, that it almost seems deliberately designed to ensure that those born into wealth remain wealthy, and that those born without wealth struggle eternally to accumulate it. The mathematics is called generational wealth transfer, or inheritance, and it is, perhaps, the most powerful mechanism for perpetuating inequality that has ever existed. When a wealthy person reaches the end of life, they do not simply cease to exist. Their wealth does not disappear. Instead, it is transferred to their children, to their designated heirs, to the next generation, and this transfer is taxed, but minimally. The tax rate on inherited assets is typically far lower than income tax rates, and furthermore, the inherited assets are received at a stepped-up basis. This means that if your parent purchased stock for $10,000 and it appreciated to $100,000, you inherit not the appreciation, not the $10,000 gain, but rather, you inherit an asset with a new basis of $100,000. You can sell it immediately for $100,000, and no capital gains tax. The entire appreciation that occurred during your parents' lifetime is erased. From a tax perspective, is entirely escaped, and you inherit not just the asset, but the tax benefit, the avoided liability, the transferred advantage. The mathematics creates dynasties, creates families that grow wealthier, not through work, not through innovation, not through productivity, but through the simple passage of time, through the inevitable death of one generation, and the inheritance by the next. And the mathematics compounds further, because the inherited wealth begins immediately to generate returns. Your parent's child inherit $500,000. At age 30, the inherited wealth begins immediately to earn, to generate returns, to compound. The child has not worked, has not earned, has not labored, but has received a $500,000 head start, while the child of poor parents must work, must labor, must earn, must struggle to accumulate this wealth over 30 or 40 years, if they accumulate it at all. The mathematics is so starkly unequal that it is almost obscene. The wealthy child inherit $500,000 at 30. Let this grow at 7% annually until retirement at 65. Without adding another cent, the wealth becomes approximately $5 million. The poor child must work 40 years, must save every spare penny, must sacrifice must struggle, and might accumulate $1 million. If fortune favors them, if they are disciplined, if they are fortunate, the mathematics ensures that the gap that existed at birth only widens, only deepens, only expands with time, and thus the wealthy person gets paid to spend in yet another way, because their spending depletes nothing, because their capital is protected, because their children inherit not diminished assets, but preserved and compounded assets. Their spending is merely the consumption of generated wealth, while the underlying capital remains pristine, transfers intact, multiplies in the background, and will eventually flow to heirs, to children, to the next generation. The mathematics is inexorable. It is deterministic. It is almost impossible to interrupt. And so, as we arrive at the conclusion of this evening's journey, as we have traversed the mathematical landscape of wealth, of spending, of accumulation and advantage, a final truth emerges with crystal clarity. The mathematics create what might be called an infinite loop, a system that perpetuates itself, that requires no external input, that functions almost like a natural force, like gravity, like entropy. Once the loop is initiated, once wealth reaches a critical threshold, the mathematics ensures that it continues perpetually. The wealthy person accumulates capital, the capital generates returns, the returns allow increased spending, the spending creates more data, more influence, more relationships, more opportunities, more leverage, more access to systems that generate even greater returns. The cycle spins faster and faster, growing and growing, deeper and deeper, while those outside the system, those beginning without wealth, must labor, must struggle, must work, must sacrifice, and even if they succeed, even if they accumulate, by age 40 or 50, the mathematical advantage has already been granted to others who began earlier, who inherited earlier, who benefited earlier. The gap cannot be closed, the gap can only widen, and thus, the mathematics explains why rich people get paid to spend money, because the system is designed, is engineered, is constructed to ensure that spending for the wealthy is never depletion, is never loss, is never sacrifice, is always the consumption of generated abundance, the harvesting of accumulated returns, the spending of interest earned on capital that remains intact, that continues to work, that will transfer to heirs, that will generate returns for generations not yet born. This is the mathematics, this is the secret, this is the structure beneath our economic system. And as you process these truths, as you contemplate this understanding, I invite you to let your mind drift gently into quietude, into peace, into the soft descent of sleep. You have traveled far tonight. You have journeyed through centuries, through mathematical concept, through the hidden architecture of wealth itself. You have earned the rest that comes now, as your eyelids grow heavy, as your breath becomes slow, as your consciousness begins its gentle fade into sleep. Let these truths settle into the deeper parts of your understanding, not to disturb you, but to illuminate, to clarify, to provide context for the world in which you exist. And as you close your eyes, as you surrender to sleep's embrace, remember that these patterns, these mathematics, these systems, they exist independent of individual morality. They exist as structure, as architecture, as the underlying framework of our economic world. and understanding them does not require judgment, does not require anger. It simply requires seeing clearly. And so, as you drift now into that beautiful space between wakefulness and dreams, I thank you for this evening together, for your attention, for your open mind, for allowing these truths to illuminate your understanding. If these explorations have brought any value, any insight to your evening, you might consider, in your own time, in your own way, subscribing to our channel, so that together we might continue exploring these forgotten pathways of knowledge in the nights ahead. But now is the time for rest, for sleep, for the quietude that you have earned. Drift gently into that darkness, that peace, that infinite silence, where all the mathematics of the world becomes quiet, becomes still, becomes merely the soft background of a mind, at last, at rest. Sleep well, sweet traveler, sleep well, until we meet again, in another night, in another hour, in another moment of quiet exploration, together